Welcome to Drill Down Earnings. We have fiscal second quarter earnings from Docusign. They're right down the street here, and that's part of the story. This is a business story behind one stock on the move. I'm Cory Johnson, Chief Market Strategist. And Docusign earnings, Q2 earnings, Wall Street likes a beat or a miss, and this was a beat. But let's look a little bit bigger, although the guidance midpoint was, they gave us some guidance as well, and that was kind of right where some other analysts were. It was a little bit below my end estimates, but whatever. When we dig into the business here, what we see is a decent quarter from a business that is growing much more slowly. So $736 million, up 7% in a year-over-year business. Almost all that, of course, subscription revenue. But the growth rates are coming down. They were, a year ago, they were 11%. Now we're at 7%. It's been steadily declining. When you look a little bit deeper here, their billings, which is sort of a sign of future growth, growing even more slowly, down to 2% growth from 10% a year ago. Not great. So a lot of that focus among the investment community, and indeed in the management conference call, was about how they were cutting costs. So down the street, I see fewer Docusign people walking around here. They've gone a year ago from 6,700 employees, 6,800 employees to 6,600 employees. Not a huge cut, but across the board in sales and marketing. Smaller spending as a percentage of revenues. R&D down to 13% as a percentage of revenue. Sales and marketing down to 30%. G&A expenses, general administrative expenses, down to 7% of revenues, down from 10%. So cutting costs, cutting bodies, cutting headcount, I shouldn't say entire bodies, just employees, nonetheless, and focus on other financial machinations, repurchasing stock. They spent $200 million buying back stock to try to support this stock price. So when after hours trading, the stock didn't do much, down about, it was down a lot, well, down a little more right after the numbers came out. People digested the numbers on the conference call, down about 1% in the after hours trading, up just 9% for the year. So they're trying to find even more ways to deliver more profitability here. And one is taking, we know what they did with e-signatures, but they like to talk about document management and what they call intelligent agreement management, IAM, as if they would do non-intelligent agreement management, whatever. IAM, they say, helps them sort of follow deal flow through a pipeline and manage documents throughout the process, not just the e-signatures. And they're trying to make that more of an automated process for the customers that aren't going to spend as much, the small and medium-sized businesses. And making that a simpler process, sort of self-service, will obviously be cheaper for Docusign. Here's current CEO, they've been through a few recently, Allan Thygesen.
We launched to the commercial segment, so the mid-market segment, stretching down to the upper end of SMB. And then here, before the end of the year, we will launch a pure self-service version, so that our ability to buy IAM purely self-service, so that'll allow us to reach all the way down, as well as, of course, remove friction for any customer in any segment. And then we will begin selling to the enterprise segments. I think initially it'll support mostly departmental level rollouts, so rollout for a sales division or for an HR team or whatever. But we think we can go with something pretty robust, and we've had a lot of inbound interest.
So turning inbound interest into dollars without a lot of expense, wouldn't we all like that? That's what Docusign is looking for. But what's this all mean? What's your big drill down earnings takeaway? The one number that tells you a whole lot, the drill down earnings bite. I'm going to have all that right after this.
The Drill Down is brought to you by Futurum Group, where analysts, researchers, advisors, content creators, and marketing experts help business leaders anticipate and understand shifts in their industries and build strategies to leverage disruptive innovation. With deep analysis, Futurum Group's extensive industry experience delivers reliable research and data, thought leadership, and actionable advice to help you with your strategy and go-to-market efforts. Futurum Group.
So Docusign just announcing second quarter fiscal 2025 earnings. They were okay, better than Wall Street estimates, but boy, growth rates are really slowing down from this business. $736 million, up only 7% on a year-over-year basis. And while this is a profitable business, the drill down earnings bite, the one number that tells us a whole lot, tells you a whole lot. That's the point. 2% year-over-year growth in billings is just not good for a business that was doing 10% growth a year ago. All right, thanks for listening to Drill Down Earnings. I'm Cory Johnson. And you can check me out at X at CoryTV. Leave some comments for us, or perhaps at TikTok at DrillDownPod, perhaps on Instagram at DrillDownPod. Let us know what you think. Like us, dislike us. I just want to know you're out there.